Good morning and welcome back to the Public Service Commission of South Carolina. We are here for the continuation of the hearing in docket number 2022-89-G. It's the application of Piedmont Natural Gas Company Incorporated for an adjustment in rates and charges. Let's start with taking a roll call of commissioners. Present in the hearing room, we have Commissioner Justin Williams, Vice Chair Powers, Commissioner Thomas, Commissioner Carol Lee Williams, Commissioner Caston, and myself, Chair Belser. And with us virtually, we have Commissioner Irvin. Any preliminary matters before we begin with the testimony this morning?
Good morning. Good morning, Chair Belser. This is
Good morning,
Jim
Mr. Jeffries. Good to see you.
On behalf of Piedmont Natural Gas. As I'm sure the Commission is aware, there was a stipulation filed late yesterday between all of the parties, as we had discussed yesterday morning, and also 3 sets of supporting testimony from Piedmont in support of the stipulation. And I wanted to advise the Commission of that filing, and also, if it's the appropriate time, move the entry of the stipulation and exhibits into the record in this proceeding.
We will take the stipulation with, I think it's Exhibits A and B. The stipulation with Exhibits A and B will be marked for identification as hearing Exhibit number 2 and received into the evidence of the case.
Madam Chair, one other preliminary issue, and if it's the Commission's preference to take this witness by witness, we're happy to do that. There has been a stipulation among the parties as to the expert status of the various consultants that are appearing in this docket. That we've all collectively stipulated that each other's experts are in fact experts within certain designated areas, and I don't know if it's the chair's preference to handle that at this point in time or once each witness comes up.
I would suggest that y'all handle that with each witness. If y'all agree, then there will be no need to voir dire the witness, but you can just state what the areas of expertise are for each witness.
Thank you, Chairman Belser.
Anything else? Good morning.
Chair Belser, just a clarification. When we call the witnesses and go through their introductions, do you want us to go through the process of laying the foundation for their direct testimony, or just skip all that? If there are revisions, cover that, and then ask for their expertise? Well,
you don't even need to go through their expertise. You can just state for the record what expert status you are presenting or they're holding for this hearing. That they're an expert in rate of return on equity and capital structure, or whatever it is, or expert in utility accounting and rate making, or whatever the area is. But I don't think you need to lay the foundation. I think everybody had CVs with their testimonies, did they not?
That's correct, and that's
so
understood.
That will be part of the record.
Absolutely.
Anything else? Mr. Jeffries or Mr. Hessling, please call your first witness.
Madam Chair, I'm sorry.
I'm sorry.
That's real quick.
Mr. Huber.
Yes. As far as order of witnesses, I know there was some discussion yesterday. So the parties under the stipulation waived cross-examination except for certain witnesses. Does the commission want to go to call those witnesses first, the ones that maybe have some availability issues, as well as and the ones that are the DCA or the other parties have reserved cross-examination for, or did the commission want to go through the original order that was filed?
If we go by the original, I want to make sure that we get through the witnesses that have availability issues. Now, if y'all can do that, going in the order in which people were filed, that's fine. But I don't want any party limited on their cross or their questions of any witnesses because of availability. So if we need to put up everybody with an availability issue first, we need to do that. I don't know what y'all got planned or how long it's going to take. I don't know how long the commissioner questions are going to take. But I don't want any party to feel like they did not get their fair share of time to put up and present their case. So I'm gonna leave it to y'all, and if we have to run late, it ain't gonna bother me. It might bother some other people up here. I don't know, but that's what I'm. So that's what I was trying to instruct yesterday. Is
Yes, Madam Chair.
if we need to take all the ones with availability first, let's do it. But I'm gonna leave it up to y'all to put it up. But y'all need to make sure that everybody has the amount of time that they need to present their cases.
Okay.
Okay?
And the parties should put up each witness, correct? All plan to put up all the witnesses, the pre-file testimony?
Yes, because there may be commissioner questions.
Thank you.
Thank you, Mr. Hessling.
Piedmont calls James Coyne to the stand. Mr. Coyne, could you please state your full name and address for the record?
Yes, my name is James Coyne, and I am a Senior Vice President with Concentric Energy Advisors. My address is 293 Boston Post Road West, Marlborough, Massachusetts.
And what subject matter are you testifying for the company?
On the cost of capital.
And Mr. Coyne, I understand that you have some...
Mr. Hessling, we need to swear the witness, please.
Oh, my bad. Sorry.
Mr. Coyne, if you would raise your right hand. Do you solemnly swear or affirm that the testimony you're about to give will be the truth, the whole truth, and nothing but the truth?
I do.
Thank you.
My understanding is you have revisions to your rebuttal testimony that was filed on July 26th. Is that correct?
I do.
And could you describe those changes for the record?
Yes, on both changes are to my rebuttal testimony. And on page 5, line 1, it reads 3-year Treasury. It should read 30-year Treasury. On page 30, figure 7 currently reads recently authorized equity ratios. It should read recently authorized ROEs. And those are the only changes that I have.
Mr. Hessling, could I ask the witness, did you say recently authorized? Should read what?
It should read recently authorized ROEs, and it currently reads recently authorized equity ratios, which are actually on the next page.
I'm sorry, what line, Mr. Hessling? Page 30 line?
Page 30, figure 7.
Yes, sir.
And are you looking for the line that figure 7 is on?
Well, now I'm at figure 7. What words changed, please? Sorry.
Yeah, let me actually go to the document itself if I could.
And Mr. Elliott, the words that are changed are on the heading, and so he'll describe it to you, but I direct your attention to the heading of that diagram.
Thank you. That'll help. And if you'll just repeat the change, please.
Yes, so on line 1 on page 30 in my rebuttal testimony, that figure currently reads the title, Figure 7, recently authorized equity ratios for natural gas utilities. That figure title should read Figure 7, recently authorized ROEs for natural gas utilities.
Thank you.
So ROE replaces equity ratios.
Yes, sir. Thank you. Thank you, Madam Chair.
Mr. Coyne, did you prepare a summary of your testimony?
I did.
And that's a summary of your direct rebuttal and your recently filed settlement testimony?
Yes, it is.
Can you please read that for the commission?
Yes. Well, good morning, Madam Chair and Commissioners. I guess I've gotten through my name and title. I'll skip that. A little bit about my background. I have 40 years of experience in the energy industry, in consulting, in corporate planning for an integrated energy company. and I began my career in regulatory and policy positions for the states of Maine and Massachusetts. I've testified on numerous occasions before state, federal, and provincial regulatory commissions in the U.S. and Canada on matters pertaining to the cost of capital for regulated utilities, including electric and natural gas utilities, transmission companies, and pipelines. In my direct testimony, the purpose of that testimony was to provide an analysis and recommendation for the cost of capital for Piedmont Natural Gas. I've estimated Piedmont's ROE based on the results from 4 models commonly used for these purposes: the discounted cash flow, or DCF model, the capital asset pricing model, or CAPM model, the bond yield plus risk premium model, and the expected earnings model. I've used model inputs based on market data, both current and forecast, from reputable third-party sources. These models produce an analytical range of estimates of the company's cost of capital from 9.04% to 11.12%, with a 4-model average of 9.95%, using then current interest rates. Based on these analyses and considering the company's average industry risk profile, I recommended an ROE of 9.9%. My initial analysis was submitted in April of this year based on data ending in February. In my rebuttal testimony submitted last month, I updated those results using the same 4 models with the most recent market data ending in June. The range of results changed only slightly from 9.12% to 11%, with a 4-model average of 9.93%, confirming my original 9.9% recommendation. Piedmont has proposed a financial capital structure consisting of 54.56% common equity and 45.44% debt. I supported Piedmont's actual financial capital structure as reasonable relative to the range of capital structures for the operating companies held by the proxy group companies. The natural gas proxy group has been selected to reflect comparable companies in terms of business and financial risks. All the witnesses providing analysis have used the same proxy group that I selected. Therefore, it's appropriate to compare the financial capital structures of the proxy group companies to the financial capital structure proposed by Piedmont. In order to assess whether the company's capital structure is reasonable and consistent with industry standards for companies with comparable risk, I calculated the weighted average capital structures for each of the proxy group operating companies for the most recent year recorded. My analysis shows that the company's originally proposed common equity ratio of 54.56% is well within the range of actual common equity ratios of 47.44% to 60.04% for the operating companies held by the proxy group over this period. And the company's proposal is also below the average of 55.7%, and that's the actual maintained by the proxy group operating companies. An additional point of comparison that may be useful to the Commission is decisions of other regulators on the cost of capital for natural gas utilities. Based on the most recent decisions in 2021 and 2022, the average allowed ROE is 9.53% with a 51.58% equity ratio. My recommendations are slightly higher than these averages, but we should bear in mind that these decisions were made when interest rates were much lower, and one would expect allowed ROEs to notch upward as costs increase for all companies raising capital. And the equity ratio reflects the company's actual and is lower than the actual level maintained by the proxy companies. Sufficient equity in the capital structure is an important factor for maintaining Piedmont's financial integrity and investment-grade credit rating, and it's an essential component of Piedmont's financial policies enabling access to capital on favorable terms in a variety of market circumstances. In my rebuttal testimony, in addition to updates on my cost of capital analysis, I responded to the evidence of Mr. Richard Baudino on behalf of the South Carolina Office of Regulatory Staff, Mr. Aaron Rothschild on behalf of the South Carolina Department of Consumer Affairs, and Mr. Kevin O'Donnell on behalf of the South Carolina Energy Users Committee, as they relate to the ROE and capital structure for Piedmont. While all three witnesses provided recommendations, only Mr. Baudino and Mr. Rothschild provided supporting analysis, so I focused my comments on their analysis and specific recommendations. One concern I have with both witnesses is their reliance on only two models, the DCF and the CAPM. Under normal market circumstances, this might not be so limiting, but capital market conditions remain unsettled due to the economic impacts of the COVID-19 pandemic, the war in Ukraine, and shifts in Federal Reserve policies designed to stem inflation. Market volatility has reached levels not seen in the Great Recession of 2008 and 9. The economy is in a technical recession, interest rates are on the rise, and inflation has reached 40-year highs. The DCF and CAPM models are highly sensitive to their market inputs, which can be balanced by also using the risk premium and expected earnings models, as I have, to mitigate these impacts. Mr. Baudino's results and recommendations come closer to the national averages than my results, and with reasonable changes, his results would approximate those that I have estimated. But it is immediately clear that Mr. Rothschild's recommended ROE and equity ratio are substantially below national averages and below any authorized return in the last 40 years, and well below those of the other witnesses. As I discussed in detail in my rebuttal testimony, his methods are flawed, unconventional, and lead to unreasonable results. His recommended 7.86% is out of alignment with any reasonable estimate of the cost of equity for Piedmont. Much like his ROE recommendation, Mr. Rothschild's recommended 44.58% equity ratio is well outside the range of authorized equity ratios for natural gas utilities, and would not provide Piedmont with a balance sheet or an equity return commensurate with its peers or a fair return. In conclusion, it's my understanding that 3 of the 4 parties have agreed to an ROE of 9.49% and a common equity ratio of 53.5% for rate-setting purposes. I further understand that the proposed settlement is comprehensive and includes agreement on many issues, not just the cost of capital, and represents the inevitable give and take required to reach a compromise acceptable to the parties. On balance, in my opinion, the 9.49%, coupled with a 53.5% equity ratio, is supported by the evidence on the record and would provide Piedmont a fair and reasonable allowed return on equity in the context of the broader settlement. I look forward to answering your questions.
Mr. Coyne is available for cross-examination.
Do you wish to enter the pre-file testimony and the exhibits into the record?
Yes.
Okay.
Well, the reason my mistake, I thought
Yeah.
when
They're
we
not
stipulated to
automatically-
that, but at this time, we'd like to move for the admission of Mr. Coyne's direct, rebuttal, and settlement testimony into the record.
Mr. Coyne's direct rebuttal as corrected and settlement testimony will be entered into the records as if given orally from the stand.
Thank you, Chair Bellis.
Exhibits, please. We do things a little different, so.
Yes, at this time, we'd also like to move his exhibits. In his direct testimony, he has 10 exhibits, 6 exhibits in his rebuttal testimony, and 0 exhibits in his settlement testimony.
Thank you.
At this time, we'd move those into evidence.
Mr. Coyne's direct pre-file direct exhibits will be marked for identification as hearing exhibit number 3 and entered into the record of this case. And Mr. Coyne's rebuttal exhibits will be marked for identification as hearing exhibit 4 and received into the evidence of this case. Thank you. Now,
At this time, Mr. Coyne's available for cross-examination.
thank you. Mr. Elliott?
No questions, thank you, Madam Chair.
Consumer Affairs?
Madam Chair, before I begin, I may want to use the projector here. Is it, it's on? Okay, great.
Mr. Hall, we need for you to talk in that microphone as much as possible, please, sir. It's on.
Okay. Is this better?
Yes, sir.
Good morning, Mr. Coyne. My name is Roger Hall. I'm with the Department of Consumer Affairs. How are you doing?
Very good, thanks. Good morning.
I see you have your testimony there in front of you. I may be referring to it from time to time. If you need a minute, to flip to that page, just let me know. Also may be able to put those pages on the overhead here for the commission.
I will, thank you.
I'm going to start by asking about page 4 of your direct testimony. On this page, you state, I consider the company's business and regulatory risks in relation to a set of proxy companies to assist in the determination of the appropriate ROE and capital structure for within the range of my analytical results. I identify risk factors that indicate Piedmont is average risk. Is that correct?
Yeah, perhaps it's due to the a difference in pagination, but I'm not seeing that language on my page 4. What does your page 4 have figure 1 at the top of it?
It does not. I'm using the page 4 that's at the bottom, the enumeration at the bottom of the page.
Okay. I'm sorry. I'm in my rebuttal testimony. Let me come back to where you are.
I've put it on the screen for you here as well, but take your time and flip to your own, please.
Great. And which lines are you on page 4?
Lines 16 through 20.
Yes, I see that language. Thank you.
So here you talk about how you look at the regulatory risks of Piedmont in relation to other companies. So I was just asking, did this determination impact your ROE recommendations?
It framed my recommendation because I used the average of my proxy group results. Yes, it did. And I also used screening criteria for companies that would be like risk to Piedmont at the outset of the analysis. So those two processes together helped me frame my recommendation. The screening initially, and then the determination that Piedmont was not riskier or less riskier than the average of the companies in that proxy group.
Did that change your adjustment, or because they were average, you used average numbers of your range? Is that?
That's correct. I made no adjustment for risk up or down within the average result produced by my firm models, although my recommendation was 5 basis points below that average. That's where I landed.
Okay. And on page 5, you conclude, overall, from an investor perspective, the regulatory structures available to Piedmont are not superior to the proxy companies, and there are aspects that are less supportive.
If you don't mind, Counsel, would you mind referring to the line numbers as we proceed here? It just helps me get there faster.
Certainly. I'll apologize if I don't have them all written down, but let's see if I can find
If you could just repeat the language, then I'll find it.
Sure. Overall, from an investor perspective, the regulatory structures available to Piedmont are not superior to the proxy companies, and there are aspects that are less supportive.
And you're on page 5 of my direct testimony?
It may be on the next page. I apologize. It's in that same section. But generally speaking, do you recall that your testimony is that the capital structures are not superior to the proxy companies, and there are aspects that are less supportive?
You mentioned capital structure in the question you just asked, but it was regulatory risk you asked the first time. I'm wondering which question is it that's being posed?
The statement I'm reading is, overall, from an investor perspective, the regulatory structures available to Piedmont are not superior to the proxy companies, and there are aspects that are less supportive.
That's correct.
Okay, thank you. On page 48 and 49, you discuss those risks in your assessment, and I will...
48 and 49, you say?
Yes, sir. And in particular, on page 48, I just want to ask you about line 20 and 23.
I see that, yes. Okay. Thank you.
On line 20, you state, let's see, I believe it's actually the two highlighted sections here, but It states Piedmont also does not have a capital cost tracking mechanism, correct?
That's right.
And below that on line 23, it states Piedmont does, however, have a capital cost tracking mechanism. And I just want to get clarification on, in your opinion, does Piedmont have or not have a capital cost tracking mechanism?
Well, what Piedmont has is different than what is typically known in the industry as a capital cost tracker. Most capital cost trackers are tied to specific types of investments. Piedmont has a mechanism that's covered under the Rate Stabilization Act, where it's allowed to adjust for actual capital structures between rate filings. So that is my understanding of the mechanism that Piedmont has, which is different from that of others that have quote-unquote specific capital cost trackers.
Okay, so
The RSA is not the same as the industry standard around capital cost tracker per se. So that's a distinguishing factor that I'm pointing out there.
okay, so, and this is, the distinction is that it's slightly different. Okay, but we can establish they do have at least some sort of capital cost tracking mechanism.
Well, they have the RSA mechanism, and it specifically allows for capital cost adjustments between rate cases. There is a lag in terms of when it kicks in terms of the company's capital cost recovery, but it does have that mechanism in place between rate cases.
Okay, and I guess just for the record, you do appear to be very familiar with the RSA, so I'm just going to show you briefly what you stated about the RSA here. This is page 49, lines 1 through 7. I will also note the highlighted portion is that sentence I couldn't quite put my fingers on a few minutes ago. But here you describe the RSA as a make-whole provision. Essentially, if the earned ROE is outside of a band of plus or minus 50 basis points around the ROE. That's
correct.
The essence of the RSA process we're discussing.
Well, that's one other element of the RSA.
So earlier on page 48, it's right here. It's the green underlined portion on line 19 on the screen. I'll give you a second to flip back. But you state Piedmont has no decoupling mechanism in South Carolina. Is that correct?
That's correct.
So given the RSA, do you not believe that the RSA is a form of at least partial decoupling?
I think that's a fair assessment. The company is allowed to update its billing determinants with its RSA filings.
So is it safe can we clarify this sentence in your opinion when it says Piedmont has no decoupling mechanism in South Carolina, that they at least have a partial decoupling mechanism?
Full and partial decoupling mechanisms have specific features that are different than the RSA. But from a risk perspective, I think it's a fair characterization.
Okay. So I guess now that we've established they at least have a partial decoupling mechanism, does that change your earlier opinion about the risks of Piedmont relative to the proxy company groups?
No, as you can see in my testimony, I took that into account. And as pointed out in my testimony, about 88% of the operating companies have either full or partial revenue decoupling. So it helped me reach my conclusion that Piedmont was an average risk utility on this basis.
Okay, I want to move on to page 10, lines 6 to 8 of your direct testimony.
I'm with you.
Okay, here you state, if investors do not expect current market conditions to be sustained in the future, it is possible that the ROE estimation models will not provide an accurate estimate of investors' forward-looking required return. Is that correct?
Yes.
Do you believe current market prices reflect investors' expectations regarding future market conditions?
Current market prices, could you be a little bit?
You may need to lean into your microphone a little bit.
If you could be more
I think your microphone's turned off.
I see the red light. Could you be more specific, current market prices for, are you talking about commodities or stock prices or interest rates or?
Yeah, stock prices, bond issuance, any other market data. Would you believe those reflect investors' expectations regarding future conditions?
Well, it's a fairly broad question, but I think that there are some expectations built into market data as they price stock prices and interest rates, yes.
And continuing in that same quote on page 10, when you say forward-looking, you mean investors' expectations, correct?
Yes. Because inevitably the cost of capital is a forward-looking cost of capital. We oftentimes use historic data because that's the best data we have available to us to estimate the required return, but at its essence, the cost of capital is a forward-looking estimate.
And when you say forward-looking, you don't mean what capital markets will actually be, correct?
Well, as I just said, where capital markets have been is also important as a data point that informs investors around past behaviors that they will oftentimes consider in terms of forming their forward market expectations. So, for example, when we measure the DCF model and or the CAPM model, it's usually constructed with a mixture of historic and forward-looking data because those are the most reliable data that we have to estimate those models. Where we have reliable forward-looking projections, those are helpful in terms of forming your estimates, but they must be reliable.
Understood. On page, this is page 23, lines 11 to 14 of your direct testimony.
Page 23, and which lines, please?
Yes, sir. Lines 11 to 14.
Okay.
You state high utility valuations are expected to decline as utilities underperform the broader market. If that is the case, the results of the DCF model would understate the forward-looking cost of equity because the dividend yield is calculated using historical average stock prices, which do not fully reflect these expectations. Is that correct?
Yes.
Okay. And so I would ask, who is expecting utilities to underperform the market? In other words, is that your personal opinion?
I was relying on the opinion of Value Line at the time that I wrote this. They had projected declines in utility valuations at the time that I prepared my evidence. And it made sense to me because utilities are very sensitive to a variety of things, but they're very sensitive to patterns of long-term interest rates because utilities use a lot of capital, and that capital is typically long-term capital. And in February, when I was preparing my direct testimony, it was evident that that central policy, bank policy, was going to be heading in a different direction. And at that point in time, it was evident that interest rates were going to be increasing. And increasing interest rates are generally not good news for utility valuations. They tend to come off as interest rates rise, and vice versa. So I was factoring in both market data and the opinion of Value Line at the time that I wrote this testimony.
And do you still claim that interest rates are expected to increase?
Oh, yes. And they have substantially since I submitted my direct testimony. When I submitted my testimony in February, the 30-year Treasury bond was 2.2%, and it currently stands at 3.1%. And in 2021, the 30-year Treasury stood at 2.05%, and it currently stands at 3.1. So it's already increased 1.05% just over the past year. And expectations are for interest rates to continue to increase, and largely because inflationary expectations have changed. And in an inflationary environment, in order to keep real returns in place for bond yields, the yields on those bonds has to increase. So all expectations are for interest rates to continue to increase, but a lot of that increase has already occurred. So the relationship between the forecasts that I was considering back in February and current interest rates, that gap has already closed considerably because interest rates have risen so much over a relatively short period of time.
But do you agree that interest rates are, while they have been increasing, are still at historic lows?
No, they're not at historic lows. Not at all. They've increased substantially since then. We had, if you look at the central bank federal funds rate, that target was at 0.25% at the beginning of the COVID outbreak. And the federal funds rate is currently at 1.5 to 1.75 and is projected to increase to 2.5 to 3.5 by the end of this year. And that federal funds rate impacts not just short-term interest rates, but also the longer-term end of the yield curve as well. So we have reached and passed the lows of interest rates during the beginning of the COVID period, and they've now marched up considerably since then.
And maybe I should have been a little clearer, so I appreciate that in all of history, yes, they are not at historic lows. Say if we discount COVID period relative to pre-COVID, would you say these current interest rates are relatively low?
Well, I guess relatively low compared to when? Pre-COVID?
Pre-COVID,
You
yes,
mean
sir.
2019?
In the 20 years before COVID.
In the 20 years before COVID, they've come back up to look more like those levels. And because inflation is now at 40-year highs, we're seeing inflation levels now 8.5% to 9% that we haven't seen since the late 1980s. So as a result of that, it's a normal expectation that one would expect that interest rates would continue to rise in order to, again, provide some real return to investors.
Okay, thank you. Go back a little bit to this discussion about high utility valuations and utilities underperforming the overall market. Would investors purchase a utility stock if they expected utility valuations to decline?
I would say that it probably, in all probability, no. An investor would wait if they thought that there was going to be a significant decline in the stock price before bringing it into their portfolio, unless they had some other need to balance their portfolio with a utility blend. But if I were an investor and I thought something was going to decline, I think I'd wait.
What reasons would an investor have to use utilities in their investment blend?
Historically, utilities have provided steady dividends, steady dividend growth rate, and returns that are low risk compared to some companies in the broader economy. They've been a particularly good fit for institutional investors and also for individual investors that are looking for income and income growth in their portfolios. That's changed over the last few years because one of the ways we measure utility risk is according to beta. And beta measures the relationship of the risk of one security to the overall market. And it used to be, let's just go back, say, 10 years or even 5 years ago, that utilities traded at betas between 0.5 and 0.6. And if the market's 1 and a beta for utility is 0.5 to 0.6, it means that it's providing a relatively low risk return compared to the market return. Utility betas have now come to be closer to the market. They're closer to 0.9 now, or in that 0.85 to 0.9 range. So as there is a movement in the market that is pricing utilities closer to the market from a risk perspective than ever in my history of looking at utility betas. So, and I think for good reasons, because the utility industry is undergoing some pretty fundamental changes, both on the electric and the gas side. So investors are looking at utilities differently than they have in the past from a risk perspective.
Do you know what capital markets will do in the future?
Do I know? No, I do not.
So you don't know what the yield on a 30-year treasury bond will be next year?
No, I don't know. I rely on either current interest rates or projected interest rates from reliable sources, but I certainly don't know.
Have you seen chart 1 in Mr. Rothschild's direct testimony, which shows that since October 2021, gas utilities have significantly outperformed the overall market?
Let me turn to it.
And for the benefit of the commission, I believe I have a copy here that I can display.
And what page was that on?
Bear with me just a moment.
I see it, page 11.
Yes, sir. And are you familiar with this chart?
I am, yes. Well, I've seen it in Mr. Rothschild's testimony.
Do you have any reason to doubt the accuracy of it?
I haven't investigated how Mr. Rothschild put together the chart, but I think directionally it's probably correct.
Thank you. If utility stocks overperform the market, would the DCF model overstate the forward-looking cost of equity? In other words, if utility stocks outperform the overall market, would the DCF then produce a result higher than the actual cost of equity?
Let me break your question down to its premise. You're asking if if utility stocks are outperforming the market. That's one piece of it. And then the second part of your question is, if they are outperforming the market, would the DCF overestimate the cost of equity?
Yes, sir.
If that overperformance was temporary, then it may, yes. That would be a concern that I would have. So if it was one of the issues that we've seen during the current capital market period is investors are acting risk averse, and for good reason. The war in Ukraine, the prospects of the economy, et cetera, have made investors risk averse. And when investors are risk averse, they exhibit a behavior called a flight to quality. And utilities are represented as part of the group of quality investments during these periods of time. If that flight to quality is temporary, and as a result of that, the prices of utility stocks were a bid up, then it wouldn't be a good indicator of the expectations for those stock prices on a going forward basis. That would be a temporary market phenomenon. That's one of my concerns with the DCF model. As much as I and other analysts use it, it is very subject to short-term fluctuations in market conditions that may not be sustainable. So
Basically what I think you're saying is expectations are what matter.
from a cost of capital standpoint, forward market expectations are what matter, yes.
And so do you agree the cost of equity should be based on investors' expectations?
As well as one can capture those investor expectations reliably, yes.
Earlier you said that you believe that interest rates are still expected to increase. Is that correct?
That's correct.
And have you made this claim in the past?
It's not a claim. I'm basing it on third-party estimates of interest rate increases, so it's not a claim I'm relying on, in this case, a consensus forecast of economists that work for banks and other institutional investment firms as a basis of their views of interest rates. So it's not my claim.
Fair enough. So have those consensus forecasts always been correct?
No. One wouldn't expect them to always be correct, but no, they have not been. Interest rates have been very difficult to predict over the last couple of decades.
Sorry. So there's a chance interest rates will go down, correct?
Yes.
Thank you. That's all I have.
Okay.
Thank you, Mr. Hall. Mr. Huber, for Office of Regulatory Staff.
No questions from ORS.
Thank you. Commissioners, questions for Mr. Coyne? Before we get to Commissioner questions, Mr. Hessling, did we state the area of expertise for Mr. Coyne at the beginning? If I missed it, I apologize.
We did, but he can restate it again because he
Okay.
said cost of capital. I think he left out also capital structure as well,
Okay.
but we can have him.
Would you
state it.
please state that
Yes.
for the record? I think I was doing something else and may have missed it. I apologize.
Mr. Coyne, could you state the area of expertise that you're testifying to in this proceeding?
Yes, the cost of capital for Piedmont Natural Gas, which includes a return on equity and capital structure.
Okay, thank you very much. Commissioner Caston, did I see you move forward?
Yes, ma'am. Thank you, Madam Chair. Good morning, Mr. Coyne.
Good morning, Commissioner.
Is it pronounced like C-O-I-N?
It is, just as you said it
Good.
perfectly, yeah. Just like the kind you would flip. Yeah.
Good enough then. I'll not flip it, but thank you very much. Do you know, in, I guess, your review of materials and such, does Piedmont have a maybe short-term, long-term master plan, capital plan?
I'm aware that the company has a capital plan. I'm not aware of over what period of time that capital plan is calculated. Most utilities have a 5-year working plan, and then beyond that, it gets a little bit more speculative. Electric utilities much more commonly file long-term capital plans because of their need to invest in generation assets. But I know nothing further of that for Piedmont.
Mr. Coyne, could I ask you to move that microphone a little closer?
Yes.
Thank you.
So you don't know for certain that Piedmont has a capital plan, short-term or long-term, but you suspect they do because most have at least, I think, a 5-year plan, you say?
That's correct.
And this, I'm not sure you could answer this either, but that plan would be developed based on what the company thought was going to occur relative to, say, growth projections, whether that's industrial, residential, in the service area they have.
That's very typical to base it around load growth assumptions, demographic analysis, computer models that we all use to forecast demand, and then that's translated into obligations to provide gas service, which would include natural gas transportation, distribution assets, contracted or otherwise, peaking load requirements. All that gets factored into a typical natural gas plan on a going forward basis, and how capital plans are formulated as well.
And
I began my career examining the natural gas and electric plans for utilities, so I cut my eye teeth on looking and scrutinizing natural gas and electric utility plans and demand forecasts.
so that's how you began looking at their capital plans, I guess, whether that's short-term, long-term plans, whatever that terminology means to people.
Yes, Commissioner.
you know, and this is just my view, 5 years to me is a short-term plan. So, you know, it'd be interesting to know if Piedmont has a 10-year plan, a 15-year plan, 1-year plan, or just kind of wake up and wing it, which I suspect they don't do that. Do you?
I would not expect that at all, no. Most utilities have a planning process that's fairly rigorous, both because it takes a long time to implement these plans, and they also need to raise capital and make sure they have sufficient staff to either contract it or otherwise if they need to lay new pipeline. So there are many elements of complexity that go into a utility plan. Winging it would never be a good strategy, in my estimation.
We both agree on that. And I guess relative to, if you think about significant capital projects, and you know that varies amongst the companies, but say a significant distribution line, storage facility, whatever that may be. And I don't know the time frame it takes to do that from concept to completion, but I suspect, you know, it could be complex, you know, regulatory requirements. You got to purchase the materials, you got to find the contractor, you got to find the land, you get just a host of things to do. Still, does 5 years seem reasonable to you to do all that?
5 years is the typical window that I see for natural gas utilities for planning purposes. It's also what they use for investment discussion purposes. Value Line does 5-year capital projections for the companies that it covers. So there is very much a focus on the 5-year window for planning purposes. But I agree with you that in an industry where it can take 5 years or longer to build these assets, that a longer-term plan can be beneficial.
Well, I guess what I wish I could better understand, and, you know, kind of looking through the material, it just didn't leap out at me, was the capital projects that are in this particular hearing, the dollar amounts, those things, certainly, would you not agree, affect the equity to debt ratio?
They do, because ultimately the company needs to raise sufficient capital to make those investments and determine what combination in debt and equity it'll use to finance them. My understanding is that's part of the company's proposal, which includes a test year around that actual capital structure, at least through the first quarter of this year, 2022. And given the direction of this commission, I would expect that the company would go forward and raise capital around that spectrum that's provided for in the decision.
But you don't know if in their planning 5 years ago, they knew that these projects were going to be what they were anticipating, and it simply worked out from planning purposes that it falls right into this time frame.
I did not examine, to be fair, I did not examine the company's capital planning process from 5 years ago and to determine how it got to where it is today in terms of the capital projects that are on the table. In my experience, the fundamental aspects of a natural gas utilities plan has two components. One are things that they know are going to happen and they need to do, either to meet new load growth or safety requirements, reliability requirements. And then another aspect that's responsive to things that they didn't know. For example, a main that was discovered to be at risk or load growth in an unexpected area, construction that requires removal of facilities from one location to another, or new regulations concerning home hookups that affect whether or not the materials that are used are still up to today's safety standards. So those are the adaptive portion of a utilities plan that need to respond to new information that they didn't have when they set their core business plan. So I think both of those things I would have anticipated to have occurred over the last 5 years. There's much greater focus on safety in the natural gas industry than we've ever seen, and for good reason. And there's much more attention and engineering expertise around which materials are likely to fail sooner and therefore create a risk. And natural gas utilities need to be judicious in terms of going after those investments and requirements as they occur.
Yeah, the easy stuff is planning for growth. The challenging stuff is when it happens and you don't know that it's going to happen.
That's right. Yeah. I mean, look at where we are in the economy. Who would have anticipated the ride that we've been on over the last 3 years? That certainly has impacted planning for natural gas and electric utilities and water utilities for that matter as well.
Agreed. Only one person that knows the future. It's not me.
Nor I.
Thinking about the future and events that have happened, and again, this is not my area of expertise when it comes to equities and everything else. If you can guess wrong or choose poorly, you can probably put me in that group. But typically, if you look historically, when things start going to heck in a handbasket, I think you mentioned war in Ukraine, COVID-19, inflation, rising interest rates, helter-skelter. Do stocks typically go up in times of uncertainty, high interest rates, inflation? And
no, this has been an unusual period, I have to say, in so many respects. You would expect, and we're in the middle of a technical recession, which means the economy has had 2 straight quarters of decline. One would expect in the type of environment that we're in that would see weakness in stock prices. But there's an expectation that investors have that this isn't going to be as bad as it appears on the surface from the core GDP numbers, because consumers still are exhibiting some confidence in their consumer behaviors, and that some of the factors that are impacting the economy are going to be temporary, such as the supply constraints associated with the tail end of we hope the tail end of the COVID-19 pandemic, and even the war in Ukraine. So investors seem to be looking beyond the current short-term circumstances that could be viewed through a pretty negative lens, and still maintaining fairly strong positions in the stock markets. So it's an unusual circumstance in terms of stocks recovering as much as they have this year, given the very difficult start that occurred in the first quarter.
And Mr. Bedino's, I hope I'm pronouncing that right,
I believe he's with us remotely.
I'll let someone from ORS correct me, but Mr. Bedino's assertion, page 8 of his rebuttal testimony, where he argues the 51.58% average of the equity ratio from your figure 1 in your rebuttal. He says illustrates the reasonableness of his recommended equity ratio of 52 or 52.2. With that in mind, would you agree or disagree that the equity ratio that Piedmont is seeking is higher than the national average?
It is, Commissioner. If you look at the most recent awarded national averages for natural gas utilities, Over the last 2 years, it's 51.58%. And if you look, there's another data point that's important here too. If you look at the awards for the proxy group companies, and these are the ones we've used for the financial analysis. So they give us a finer lens to look at the gas industry through because they're most like Piedmont in terms of their overall risks. Their average is currently 53.53%, so nearly identical to the proposed equity in the settlement of 53.5. So that's within 3 basis points of that average. Another data point is that if you look at the actual equity ratios maintained by the proxy group operating companies, so these are all the gas utilities these proxy group companies own, their average is actually 55.7%. So if you take a look at those 3 data points, the national average, the proxy group awarded ROEs, and the proxy group actuals, I think that the proposed equity ratio is comfortably embraced by them.
Are you, do you have any, I guess, statistics background or, I mean, I'm not real good at that, so I'm gonna put that right up front. I had to take it, but I hated it. But, you know, you mentioned the proxy group. I think you started with 10 and honed it down to 6. Is that correct?
Yes, sir.
Relative to, say, probability, statistics, or whatever terminology you want to use, is the margin error greater in a smaller set, larger set?
It's typically greater with a smaller set, your margin of error. You'd prefer 10 over 6, but the trade-off there is that you want whatever group you decide to look as much like the company you're regulating. This is a pure play natural gas distribution utility. So you're willing to trade off a larger sample for a smaller one if that smaller one is most representative of the company that you're trying to determine, in this case, the cost of capital for. And 6 is generally deemed to be sufficient for those purposes. FERC has a standard of 4. It will not go below 4 in its cost of capital determinations for pipelines and transmission companies. So 6 provides a little margin of error over that 4, which I would find pretty low. But we've seen a lot of consolidation in the industry, and as a result of that, the number of pure play gas utilities, or electrics for that matter, is diminishing over time as more of these companies are rolled up into larger holding companies.
Well, do you have any concern, and I don't know if these are the right terms to use, self-fulfilling prophecy or groupthink, do you have any concern that, you know, what if the proxy group is wrong? What if it's self-fulfilling, or hey, they used it, you know, everybody, if the 6 are using the same 6, aren't you running a race in the circle?
Well, you have it's a good question. You have a couple of different mitigating factors there. One is that you're looking at least with the DCF and the capital asset CAPM models, you're looking at investor expectations for those 6, but you haven't gotten around the problem. You've specified it, you still have 6 companies, but we're looking at the market expectations for those 6. One of the reasons why I like the risk premium model that I've used is it is divorced from those 6. And you're looking at 40 years of history for regulators across the United States and how they have set ROEs for natural gas utilities. So we have hundreds of observations there across various market conditions and interest rate periods. And what I've done with that model is to estimate how regulators have determined the allowed return for a gas utility when the interest rate was 8%, when it was 6%, when the economy was in recession, or when it was in a growth mode, and determined the average regulatory determined relationship between fundamental underlying bond yields for the risk-free government bond rate and the allowed return for utility. So that model is divorced from those six and also provides a very long period of time if you look at the history of how these decisions have been made. And so that's one of the reasons why I really like to use that model. It gives you a check against what's going on in the markets over a very long period of time for all natural gas utilities that have had regulatory decisions around their cost of capital.
Are there any perfect models?
No. That's why, again, I like the four. I take some comfort in looking at the perspectives of the four and looking at the balance it brings between them. I've seen cases where the DCF model will produce results that I question, and I've seen other cases where the CAPM will do the same. And I take comfort in having some check using the expected earnings and risk premium models that are less reliant on what's going on in capital markets today.
But you agree that no matter whichever model you use, the outcome number is going to be only as good as the input numbers, correct?
I could not agree more, sir.
And most of those numbers, if not all of them, I can't remember all the models in my head right now, are subjective or objective, which, in other words, this number comes from this group that's predicting what's going to happen here, or this group that's what's going to happen here. A lot of the inputs are educated guesses. Is that a fair term?
Well, there are two pieces to your question. One is there a perfect model? And as I said, no. But I would not say that the models are subjective. The models themselves are objective. What is subjective is how you choose the inputs to the models. And that's why you will see, as we have here, for example, you have three witnesses in Mr. Rothschild, Mr. Baudino, and myself that have estimated the CAPM and the DCF models. Same model, but our inputs are different. Mr. Baudino's results and mine are relatively close together because we selected inputs that are somewhat standard and they come from industry sources that are somewhat typical for what we see for estimating the cost of capital for utilities. Mr. Rothschild has also used the DCF and CAPM models, but he has used very unconventional approaches for selecting those inputs with a lot of judgment and analysis in his option implied beta work example. That's not typical to be used for inputs to these models, and as a result of that, he gets results that are not surprisingly very different. So you have to look both at the models themselves as well as the inputs and make judgments on the reasonableness of them. And that's the challenge that your commission faces, of course. But my own view is the more you can rely on market data and data from third-party sources, the more confidence you can have in those results as being reflective of how investors would be looking at a required return through an objective lens. So you're trying to take the subjectivity around inputs, reduce it to the extent you can so that you have a reliable result.
All right, now, I think Mr. Rothschild will get a chance later on, but could you be more specific relative to where you said his methods or whatever were more unorthodox? In other words, why should I believe his less than I believe yours?
That's a good question. Well, Mr. Rothschild does several things that are, let me just characterize them as unconventional. And let's begin with the CAPM model. He uses two measures of interest rates. The heart of the CAPM model is an interest rate, a market equity return, and beta. It's a pretty simple model. There are only three inputs. We're trying to determine the cost of capital for a utility that makes investments that are going to last for 30, 40, and 50 years. And the cost of capital estimate is typically based on long-term estimates of the cost of capital. He uses a 3-month treasury yield. I've never seen this done before. As well as a 30-year treasury yield, more typical because it's a long-term investment. But he uses either a spot, like what's the price today of that yield, or he uses a 3-month average. So to begin with, you should never use a 3-month treasury yield, which is a short-term cost of debt at best, as an underlying determining factor, the cost of capital for regulated utility. I've never seen it done before. The shortest I ever recall seeing was 10 years, let alone looking at a 3-month treasury yield, which forms part of his analysis. And he also looks at the spot value of that, and as volatile as capital markets are, today's price of a 30 or a 3-month treasury yield is pretty limiting. Another aspect, and probably an aspect of his analysis that's even more unconventional, is how he approaches the estimate of beta. And beta is typically provided by services such as Value Line and or Bloomberg. And Mr. Baudino has used the estimates provided by Value Line, as I have. That's very typical. You don't have to argue about that. It's an investor service. Everybody knows how Value Line Capital estimates betas. But Mr. Rothschild calculates his own betas using option analysis around how utility stocks are trading over the next 3 months. And with options, you have a much more thinly traded market, and you're only looking at a 3-year period on a going forward basis. And as a result of that, you produce very unreliable results. I'm not aware of any other analyst in the US or Canada that has used his approach to estimating beta. And it's highly unconventional, and even the academic literature that he cites indicates that this is not really ready for prime time in terms of this type of a purpose. It's really something that's a developing theory around estimating betas, not something that's been broadly accepted by any means within the regulatory community. But at the end of the day, his DCF analysis, he takes two different approaches. One is using what he calls the constant growth method, and the other is a non-constant growth method. And in his non-constant growth method, at least he uses Value Line dividend growth rates. And there you can come up with a result that's a little bit more reasonable. He estimated results there of 9.25 to 9.47. It's probably the closest he comes to results that are bordering on the mainstream. And all of his other results are just simply out of bounds in terms of what any reasonable estimate is for cost of equity today. But if you look under the hood, as we have at Mr. Rothschild's work papers and things of that nature, you can begin to see what some of the challenges are. The Hope decision, those that look at cost of capital for regulated utilities look at the Bluefield and Hope standards. And the Hope standard of the U.S. Supreme Court, in essence, says, in part, it's the result that the achieved result that really matters. And his average CAPM result is 6.33%. And today, the cost of debt for an A-rated utility is 5.11%. So his CAPM numbers, based on this option implied data and these very short-term interest rates or spot numbers, would produce a CAPM result of 6.33%. And if you're an investor and you can buy an A utility bond yield that'll earn 5.11%, why would you invest at 6.33% and take the risk of a common equity investor for only that type of a margin? There's no reasonable estimate of the cost of capital that would be that low. And if you look at the individual results for the companies, his CAPM results range from 0.15% to 9.99%. I don't know how you could place confidence as an analyst in numbers that look like that. And then another case in point is if you look at his analysis for Spire, which is one of the 6 companies in the proxy group. His analysis of the cost of equity declined from 8.2% on June 7th, 2022 to negative 2.23% on June 14th, 2022. So from June 7th to June 14th, that's a week, his analysis predicts that Spire's cost of equity went from 8.2% to negative 2.23%. So that, as an analyst, tells me that there are some fundamental issues associated with how the reliability of those inputs based on the kind of numbers that you get coming out of it. So I don't believe that his analysis is reliable or conventional and should be used for the purposes of setting the cost of capital for Piedmont Gas.
Thank you. Let's see what Mr. Rothschild has to say later. Thought I was through, didn't you? A few more questions, and I will be, I promise. So should one look forward or backwards, to figure equity debt ratio, returns on equity and such? Because I've kind of heard both things. In other words, I've heard, we need to, what are the forecasters projecting, relative to interest rates or equities? Which is it?
I always prefer to look forward because the standard for cost of capital is a forward-looking one, again, as long as you can do it reliably. I'm sensitive to the criticism that was implied by Council's questions earlier around the reliability of interest rate forecasts. I recognize that interest rate forecasters have had a tough couple of decades. And as a result of that, I provide my estimates of the cost of capital based on both current interest rates as well as a projected interest rate. And I ultimately based my recommendation based on current interest rates, both in February and in June when I updated my analysis. I would typically prefer to use a forecast interest rate because I think investor expectations of forward-looking markets are important to factor in, but not all parties agree. So I provided my analysis based both ways, and ultimately my recommendation was based on current. But again, as I mentioned earlier, the relationship between current and forecast has collapsed some. So as a result of that, the difference isn't as important as it would have been, say, a year ago or 2 years ago. But I usually prefer forward-looking to the extent, again, you have reliable estimates. And in the DCF model, I rely on 5-year forecasts of earnings growth. And in the CAPM model, I rely on a forward-looking estimate of the market equity risk premium, which I average with the historic in order to provide some balance around where the market's been and where it's going. So I have a mixture of history where I think it's more reliable and forecast where I think it's adding value to the estimate.
Have you or do you look back at what experts or whomever that might be have forecasted versus what was actual? Have you looked at that history?
And is that for interest rates specifically? Yes.
Interest rates for now and then returns on equity.
Well, for interest rates I have, and I think it's probably fair to say that over the last couple of decades, we've enjoyed an incredible period of declining inflation. That's been below 2%. And I think for any of us that have a home mortgage, I tend to be conservative when it comes to these things, so I like fixed rate mortgages. So I'll sign up for one that's going to last for 30 years, thinking that, wow, interest rates can't get this low, and only to find 4 years later, wow, we could do better than that. So I think most of us that have owned mortgages have capitalized on that because their own expectations of rates going lower were exceeded by what was really going on in the economy. So I would say that it's fair to say that interest rate forecasters and investors in general have their expectations of interest rates were probably higher than what was experienced in the market in general over the last 20 years. I think we're now seeing the opposite is true because interest rates are rising faster than anybody predicted in the other direction. So it's a very difficult thing to forecast. Interest rates bring together a lot of aspects of the economy, expectations around inflation and things of that nature. So I have looked at it in the past, and I would find that that is a difficult area of forecasting. I used to forecast for a living doing energy forecasting, and I was always humbled by how challenging it was.
So I'm not sure I heard you say this specifically, but if you looked over the last 20 years, previous 20 years, 21 years, whatever it is, that in every single case, the forecasters overprojected the actual. Is that a fair statement?
For interest rates?
Yes.
I don't know that that's the case because we've had some ups and downs in the economy. I would say the general trend has been that case, but I'm not sure that that's always been the case over that period of time.
But it would be easy enough to find out, though, would it not?
Sure, one could look
It's just
at
a historical thing, correct?
Yes, it would. Yeah.
Same thing with return on equity, correct?
Well, let me go to your question there because it's different. You had
Yes.
asked if reliability of forecasting the return on equity was reliable. The return on equity is a forward-looking concept, and it turns into an allowed return on equity. So you don't have a forecast of what it was going to be versus that which was allowed that would make any sense because these are decisions that commission reaches with the evidence before them and the record at the time. What I have done is gone back and looked at the relationships, as I described, between commission decisions and the actual level of interest rates, and that's what forms the basis of the risk premium model that I've estimated. So that takes out the uncertainty around interest rate forecasts because you're looking at the actual allowed ROE and the actual interest rate that prevailed during that period of time. And so there's no forecast error that's involved in that analysis. And the risk premium estimate that I come up with using that and current market data is 9.87%. And I should check that. I've estimated the risk premium 3 different ways using current interest rates, a forecast for 1 year, and a forecast for 5 years. So that's in that average that I just mentioned of 9.94% on a forward-looking basis, but it's based on actuals over a long period of time. If you want to know the number based on actuals over a long period of time and current interest rates, I could give that to you if you'd like me to look that up.
Madam Chair, if I could, I actually would like to see that or have that.
Go ahead.
Let me just turn to my rebuttal testimony, which has the current exhibits.
And I want to make sure we're looking for the same thing because I looked through these exhibits, but we're talking about the previous. Well, point it out and then I'll decide. That's what I'm asking.
Okay, so that number that I cited to you, Commissioner, is actually based on the average current 30-year bond yields of 9.87%. So to interpret that for you, if you look at the history of allowed returns for natural gas utilities and this goes back to 1992. So you're basically looking at 4 decades of decisions. And what I've taken is the average natural gas allowed ROE in that period. This is measured on a quarterly basis. And then the U.S. 30-year Treasury yield in that quarter. That the risk premium that comes out of that was the actual risk premium awarded by these commissions across the country in that period of time. And then if you look at that relationship based on current interest rates, that produces an average result of 9.87%. Again, that's not tied to 6 companies, that's based on all decisions.
Mr. Coyne, could you direct the commission to the exhibits you're looking at in your rebuttal testimony, just to make sure we're clear?
That's based on rebuttal exhibit JMC4 that reflects data through the end of June. I could give you a page number, but I don't have that on the exhibits, but it's exhibit JMC4.
Did you know that I didn't bring my glasses?
I wear them both up and down, so
Well, I'll have 4 pair and they're all in the truck.
those numbers are small.
Yes, they are.
In column 9 on the 3rd page of that's the last page of that exhibit, is where you see that 9.87%.
Okay, thank you. Relative to the historic projected expert interest rates versus the actual over the last 20 years, you don't happen to have that info, do you?
Well, that's what this model is based on. So if you flip back, to page 1 of that exhibit, I apologize for the font. You can see in column 2, well, let me just orient you to the exhibit if I can. Do you have the ability to blow that up on your
Yes, I
computer
do.
to
She's
make-
done it for me, so let
Okay.
me make sure
Okay.
that we're talking about the same thing.
So in column 1, Commissioner, what you're seeing there is the average gas authorized ROE in that quarter, and that's the first quarter of 1992. Interest rates were high then. The U.S. government Treasury bond yield was 7.8%. So in that quarter, commissioners in this country on average determined a 12.42% ROE for natural gas utilities. The difference between them is the risk premium, 4.62%. Yeah. And that's calculated for each quarter based on actual allowed ROEs and actual interest rates over the last 4 decades. Through all kinds of economic cycles and interest rate cycles. You can see that interest rates were, we probably both remember when interest rates were pretty high during this period of time, when government bond yields were over 7%, in some cases approaching 8%. So this model analyzes the relationship. If you take a look at the picture on page 3.
I see what you have here. I understand this. Yeah. And it could be that I'm asking just a really dumb question, or I just have acute lack of understanding of what I'm asking, because I see what you have here. But what I was curious about, and maybe this is that same thing. But at least in my simplistic way of doing things, I can recall times when Joe Expert would come on the TV and say, we anticipate interest rates being X. And then there'd be some jackleg that would guess even wilder, and he was typically the young guy. But that was done every year. What would be interesting is to see what those experts predicted relative to just interest rates versus what were they really looking back in time. In other words, look, I'm simply trying to better understand or get a better picture of, and I understand that, you know, it's like with growth projections and everything. We can only make the best estimates we can based on the best available information and the best minds. But having done similar things personally in studies and things like that, man, they were good studies, and we did it all right. I mean, we put all the numbers in the right place, went to the right sources, came up with the right stuff. And I have the ability now, since I'm older, to look back on some of those things and realize that some things, you know, didn't look too bad. Some things we weren't even close. My only point being is experts do the best they can, but looking back to see how accurate were they over the course of time, I find that interesting in that it matters. Do you?
Yes, yeah, I do. I think track record of, I think track record of forecasting is important to keep in mind. It gives you a sense of how difficult it is to forecast the underlying measure. I used to work for a firm called Data Resources Incorporated that was owned by McGraw-Hill. And we had giant economic models that projected the economy, interest rates, state-level economies, almost every aspect of the energy industry you could think of. And these models were the largest of its kind. Back in the day, we used mainframe computers to fire up these things. And we put the best minds we thought we had on these. And they were relied on heavily by both government planners and utility planners, and some things are just easier to forecast than others. You know, GDP, for example, was much easier to forecast than the price of oil because it's inherently volatile. But I think what two things I could offer that might ease your, and I appreciate where you're coming from, that might ease your concern. One is that when we're setting the cost of capital for a regulated utility, it doesn't matter that we're right in terms of knowing exactly what's going to what will happen in markets in the future. What does matter is that we have captured investor expectations, and that's what we're trying to do. So we're trying to create a forward-looking cost of capital that's consistent with a reliable estimate of investor expectations. And so we will look back, and if I come before you in 4 years, I'm sure that some of the estimates that are contained in these testimonies will be different from what actually occurred. But did we have investor expectations right when we framed them? I believe that I have adequately captured them in the 4 different analyses that I'm bringing to you. But I have realized the concern and accuracy around interest rates. So the analysis that my recommendations are based on current interest rates. So there's not a forecast in there that is the basis of my cost of capital recommendation. I've estimated them using forward-looking interest rates as well, but my recommendation is based on the current interest rate version, where interest rates get factored in.
I understand, you know, that the focus, as I'm hearing you say, is also on potential investor expectation. And you mentioned Hope and Bluefield, which I've been here just a tad less than 2 years, and man, I've heard that a lot. I've heard it so much that I actually read it more than once. Does Hope Bluefield guarantee a rate of return?
No, sir. It's an opportunity to earn a return that's a fair return,
That's
not a
correct.
guarantee.
And what does opportunity mean to you?
Well, the way it's typically interpreted is under reasonable expectations of operational and market conditions and a regulatory environment, the utility should be allowed the opportunity to earn a return that's fair and commensurate with the return that it could earn elsewhere for a similar level of risk. So that's the standard by which the cost of capital is set. And there are usually three elements to that standard that the return should be set such that it's comparable to investments of like risk. It should be sufficient to allow the utility to maintain the integrity of its company, and it should allow the utility to attract capital on reasonable terms on a going forward basis. If it meets those standards, it's met the standards of the Hope and Bluefield Supreme Court test for reasonable and fair return.
When assuming what you have in your direct testimony is the direct excerpt from that, you know,
Yes.
you'd say the return should be reasonably sufficient to assure investor confidence in the financial soundness of the utility and should be adequate under efficient and economical management to maintain and support its credit and enable it to raise the money necessary for the proper discharge of its public duties. And that's a lot. But should be reasonably sufficient. What is, I'm trying to think how to ask this other than what is reasonably efficient or sufficient. Is reasonably sufficient greater than 0?
Oh yes, it's greater than 0.
Is it 15? Is it, I mean, what is reasonably sufficient?
Well, in order to determine reasonably sufficient, I rely on models to estimate what an investor would require to invest in a utility of a risk profile such as Piedmont. And that gives us an estimate of the required return and serves as a proxy for what is reasonably sufficient.
But Hope Bluefield doesn't define exactly what that is or how to determine it or what methodology is correct, does it? Or does it?
No, it's quite open in that regard. Yeah, and you have to bear in mind that these were decisions that were written in 1923 and 1944. So we didn't even have the models that we have today for estimating the cost of capital. But they've been remarkably resilient decisions. And I also testify quite a bit in Canada. And it's interesting to me that Canadian experts and commissions cite our Hope and Bluefield standards in addition to an additional standard in Canada for setting the reasonable return there. So it's they're very broadly used, even though the framework is reasonably broad and allows some discretion certainly for commissions within those standards.
And it says should be adequate, comma, under efficient and economical management. So seems like the Supreme Court recognized that nothing's guaranteed.
Right, and there's a certain expectation on the utility that it's going to run its company well and not look for a return on costs that are not prudently incurred in order to serve customers. So there's a standard of quality of service that's implied by that language in my mind.
And I'm not saying it's not, but how do I know that Piedmont Natural Gas is an efficient and economical managed system? How do I know they ran well? By what metrics? I mean, how do I know?
Well, one of the lenses that a regulator typically has in that regard is to look at benchmarking for costs of Piedmont in this case versus similarly situated companies. Another tool that's used is called total factor productivity analysis, which is a more sophisticated version of benchmarking that's designed to look at what an efficient utility looks like, and then it compares that efficient utility against what the target company is. Benchmarking is more commonly used, though, because it's intuitive. You can look at operating costs per customer and per mile of main and line, and things of that nature. So these are tools that are typically used by regulators when they want to look at just how well a utility is being run and to understand that it's being run efficiently.
Generally, I agree. I kind of like that stuff, and perhaps I've overlooked it, but I've just not seen any of that stuff really from any utility.
Commissioner Caston,
Yeah.
we've been going about an hour and 45 minutes. Let's take a short break for about 10 minutes. That's agreeable.
Saved by the bell. Yes, ma'am.
Showing about 11:12. Let's return at 11:25, please. Mr. Coyne, I'd remind you you're under oath. Please do not discuss your testimony with anyone. Thank you.
Thank you, Madam Chair.
Welcome back. We are in the hearing in docket number 2022-89G. Let's take a roll call of commissioners. With us virtually is Commissioner Irvin, present in the hearing room, Commissioner Jay Williams, Vice Chair Powers, Commissioner Thomas, Commissioner Carol Lee Williams, Commissioner Caston, and Chair Belser. We are still in Commissioner questions of the witness, Mr. Coyne, and we're still on Commissioner Caston. Commissioner Caston?
Thank you, Madam Chair. Thank you, Mr. Coyne. I'm gonna wrap it up, I promise. You referenced the broad stock market in your testimony, and what is the outlook for stocks as a whole?
When you ask that, are you looking for an indication of the performance of the S&P 500 over time or long-term stock returns? Could you be a little bit more specific in terms of your question for me?
Well, I will now. I think a response to both of the things you just said, because I had not thought of that. I thought, well, yeah, that's a good point. So what, generally, whether it's the S&P or the Dow or whatever, and, and like I say, I'm awful at this. You don't want to use my history or record. But, one's more predominantly utility oriented and, the different ones, which this is what you guys do, not me. But I know when I look at those little lines, history's great. I can look at that with absolute certainty because it happened. But now, you have the prognosticators and the experts, and we believe this sector is going to do this. We believe S&P is going to do this. So can you answer both of the questions you asked me?
I will, yes. So I would say the near-term outlook for the market is highly uncertain. I guess that goes without saying, pretty bumpy. There are two offsetting factors. One is that the underlying pillars of the economy are still quite strong in terms of, as I mentioned earlier, consumer confidence remains at acceptable levels. The construction industry is impacted negatively. There are a lot of industries that are impacted negatively by rising interest rates. Construction is a key driver of our economy, and rising interest rates is not good for construction and not good for buying homes and other fundamental aspects that serve as engines for our economy. So those are moderating on one side, but yet consumer demand for durables and everything represented from automobiles to computers is still quite strong. So in terms of the ups and downs of the stock market this year, I would say expectations are that there are not going to be any big increases in the market this year, and there's probably still some expectation it could move downward. Longer term, we look at history going back to 1926 when we make these determinations. The stock market has performed quite well. It produces annual returns that have averaged close to 8% over that period of time, 7.5% to 8%. If you look at expectations for analysts that project growth for the market and growth for the individual companies in the S&P, those expected market returns are 13% and higher. And what I do is I take the average of history, because I like history, going back over close to 100 years, and I average it with what analysts are projecting for the market to come up with the expectation that I use in the cost of capital analysis. So a lot of history in there, and then some reliance on the analyst forecasts together that gives me the market return that's included in my cost of capital analysis. And if you want to know what that number is, I could point you to it if you're looking for something that specific. But that's the general narrative.
If it's in there, that's good enough. And you had mentioned earlier, I think, and if I have this wrong or the number's wrong, let me know. Why would an investor take a risk of 6.3% ROE when they can have a bond at 5.3%. It was something like that. Do you recall that?
I do, yes.
And I had to think about that some. And I want to make sure I understand what you're saying. Are you saying, like, let's pick another investor other than me. I'm not good at it. But someone on the street that does this, and they're looking at, okay, I can get a 5.3% on this bond or 6.3% on this stock. Now, why would they not want the extra 1%? Why would they choose the bond over that particular stock?
Right. Let me put that in perspective. Yeah, I was citing to the A-rated utility bond, and that's a very strong bond, but yet that's currently returning, as of yesterday, 5.11%. And so these are some of the best utilities in the country. And if I buy a 30-year bond, I have a pretty good guarantee of earning 5.11%, which is the current yield. Not an absolute guarantee. It's not a government bond, but it's a very strongly rated bond. And if you were to consider an estimate in common equity, you're not a bond investor. You're only going to get a dividend and a return as long as the company does well. And if they don't do well, you're at risk. I think we've all owned stocks that have disappointed us in that way in our 401ks or otherwise. And to be fair to Mr. Rothschild, I was citing one of the results from his CAPM models, but his overall recommendation is 7.86%. And if you compare that to a bond yield for these utilities of 5.11%, that's only an equity premium of the difference between 511 and 786. So we're looking at 275 basis points. And there is no reasonable estimate of that as being the required equity premium over a bond yield that I'm aware of. Equity investors typically require a much greater premium in order to take the risk of owning common equity. FERC throws out numbers that are near the bond yield. I don't remember the exact criterion that FERC uses, but they use it as a way to throw out numbers that are unreasonably low. And many of Mr. Baudino's estimates would cross that boundary in a 7.86%. Just on the superficial level, compared to a bond yield of 5.11, is clearly inadequate from a cost of equity standpoint. That's the point I was trying to make.
Okay. And help me better understand this too. When you talk about risk, the risk, if whatever the commission does, whatever that return on equity rate is, now what is the risk with that for the company and the investor? If we approve 12, whatever it is, what's the risk? Where's the risk?
For a common equity investor in Piedmont?
Yes.
Yeah. The risk is that economic conditions will change, and the company will, for some reason, not be able to earn that return. If you think about the risk for gas utilities these days, you'd also have to include the risk that of climate change related decarbonization legislation that's happening across the country, or even individual companies and consumers that are deciding that natural gas is not necessarily what they want to be using in the future. So there's a risk that the business that the company is in today will look very different tomorrow. And if that's the case, that could compromise the company's ability to earn a return on equity, or actually recover the assets that it has invested in the ground today on a going forward basis. So those are the types of risks. There are also operational risks pertaining to the gas industry that I think we're all well aware of. And the company is liable for operating that system in a safe and reliable way. And if it fails to do so, then there are lots of liabilities associated with not doing so. And those liabilities are borne by the equity investor first, and bondholders down the road from a credit perspective.
But if they are approved, say, to make up to a return on equity of 9.9%, which I think was somebody's recommendation, maybe yours.
It was, but it's also worth noting that the proposed settlement is
9.49%.
9.49%. So I think that's the number that I'm speaking to currently. But that was my original recommendation of 9.9 based on the financial analysis.
Well, whatever it is, then it would be the commission saying, hey, you can make up to that. Correct?
Well, my understanding of the RRA is there is a boundary around that of plus or minus 50 basis points.
So if the company, if they really are run poorly and whatever, you know, they don't make that return on equity, what happens?
I misquoted the RRA, it's RSA, but if in the short term under the RSA, the company would have the ability to come back to the commission with its annual filing and seek to carry forward that difference in a future rate period below the 50 basis points if it were under earning in the short term. In the long term, if that were the case, then it would be up to the company to come to the commission and look for a settlement around if its fundamental business is changing and the expectations of useful lives of its assets, for example, which is an issue these days, was changing. It would be up to the company and commission to come to an agreement pertaining changes in depreciation rates and how those assets would be recovered.
And I'm not trying to be repetitious for repetitious sake, but I'm going to have to circle back and ask that question again based on that too, because I agree with you. Where's the risk?
Well, as I mentioned, the risk is in the short term that they have that 50 basis point exposure around their allowed, and in the long term that their fundamental business model changes and that they need to be able to recover the invested rate base that's in place today in some reasonable way. And there's no guarantee around that, depending upon the future path of policy in the state of South Carolina and federal policies that are impacting what these businesses are going to look like in the future.
Does Ford Motor Company have an RSA or any guarantee on their rate of return?
No, they're an unregulated company.
Yes, they are. As are many. But there's no guarantee on any of those, are there?
For an unregulated company, typically not. You know, there, as we know, Ford Motor Company got into trouble during the Great Recession, along with the other automotive companies, and the federal government came to their aid, but that's not typically the case.
But with this, and the gas companies that are regulated, they're allowed up to or guaranteed, although said there's no guarantee, a particular return on equity, and if they don't make it, then the RSA, in essence, subsidizes it, correct?
I wouldn't say subsidizes it, but they have an ability to make up for that shortfall within that 50 basis point band.
So who has the greater risk relative to the economy affecting their profits, ROE, and return, rate on return, and everything else? Ford Motor Company or Piedmont Natural Gas?
Well, I would say Ford Motor Company. But, you know, that's factored into the cost of capital analysis that I've done because reflecting back on the conversation we had earlier, what we're trying to do is to determine an appropriate rate of return for companies that have the same risk profile as Piedmont. So I didn't use Ford Motor Company for that purpose. I used other regulated gas companies so that we can address the issue of what's appropriate for Piedmont compared to its peers and not other companies that have different risk profiles, such as Ford.
I understand that. And in your direct testimony, when you did talk about the broad stock market as a whole and or stocks as a whole, you know, that would include not just the proxy group, but the broad stock market as a whole, correct?
That's right. And then from that broad stock market as a whole, we determine what types of returns utility investors require that are different than the broad market as a whole. And that's what's measured by beta. And that's why it's so important to get that right and reasonable in the CAPM model.
All right, final questions, I think. You'd mentioned, you know, when I'd asked about whose information or methodology was better, in essence, yours or Mr. Rothschild's, you know, what were the shortcomings, I think, and you went through some items. And one of the things you talked about, I think, was Mr. Rothschild using a 3-month, I guess, Treasury rate, and it was non-conventional. Let me ask this: is conventional always right?
No, conventions change, but when they do change, they usually change for good reasons. If you have a convention that's being replaced by something that's more reasonable, then I would expect that you would find some headway around that new convention. I see no evidence of that with Mr. Rothschild's methodologies. He cites to a couple of examples in Connecticut and here in South Carolina, but he has 4 pages of places where he has testified, and those are pretty limited examples. And even in Connecticut, which he cites as an example of where his analysis has been accepted, the commission placed no weight on the CAPM analysis that I've taken issue with here that uses this option implied beta analysis, and that commission was ultimately set aside and returned as a settlement. And as I mentioned, there was no weight in that decision even before the settlement placed on Mr. Rothschild's CAPM analysis. So he's operating at the boundaries of conventional, and again, I'm not familiar with any analyst that has attempted to take this approach and to use it for determining a regulated cost of capital for a utility in the U.S. or Canada.
I mean, converse to that, is unconventional always wrong?
It is not always wrong, but it needs to be proven to be right and reasonable, and I don't think it's passed that test.
And I don't want to put words in your mouth here, but I know when you were talking about the previous 3 years, I don't know that you used unconventional or whatever, but I think you rightly pointed out it's been an odd, weird 3 years. COVID-19, Ukraine war, inflation, just odd.
It has, and I think that's a very important point to keep in perspective here, that it's because capital markets are in such a state of flux. I don't believe it's a good time for making broad changes in something as important as the return on equity for regulated utility. It's based on fluctuating market conditions. So that's why I take some stock in having a broader perspective, not just on the models which I use and other analysts use, but broader measures such as the national average allowed returns. Because if you look at the Hope and Bluefield standards taken broadly, it's asking the question, what's a commensurate return for a utility like this? And I think national averages are very informative and helpful in that regard. And they come very close to the proposed settlement at this point in time. The national average ROE, as I mentioned, is 9.53% today, and that's taken over the course of 2021 and 2022 when interest rates were much lower. So it's reasonable to expect that today that the cost of capital, including equity, has gone up over that period of time. So my view is that the proposed settlement of 9.49% is very conservative because it's even below that national average at a time when we know the cost of capital is increasing and has increased.
Thank you, Mr. Goin. I believe I'm through.
My pleasure, Commissioner.
Thank you, Commissioner Caston. Commissioner Williams, is your light on? Jay?
Yes, ma'am.
You have the floor.
Madam Chair, if you don't mind me asking, what time do you plan on taking afternoon lunch break, or are we taking one?
We'll probably look at, depends on where we are in the questioning, but probably about an hour or so, about
Thank you, ma'am.
12:45 or so, 1 o'clock.
Thank you, ma'am. Good afternoon, sir, or it's still morning.
Good afternoon, Commissioner.
I appreciate your patience with us. You definitely have shared a lot, and I've enjoyed listening to your testimony. I just want to get a better understanding in a few areas. Start out with some questions for you. Do you understand the role of the Office of Regulatory Staff in our state?
I believe I do.
Okay. What is your understanding of the role of the Office of Regulatory Staff?
My understanding is that the Office of Regulatory Staff serves as an independent entity and an advocate for consumers in such processes as we have before us today.
Okay. What about the Consumer Advocate's Office?
The Consumer Advocate plays a similar role, as I understand. I think they have, my understanding is that they're independently funded and act independently, but their mandates are similar.
Okay. And South Carolina Energy Users Committee, do you understand their mission?
I believe I do, yes, that they're acting on behalf of typically larger energy users in this process.
Okay. I will add to the Office of Regulatory Staff's mission based on what you shared. They represent the public interest, and that's been defined loosely as all classes of customers and protecting investment and or ensuring continued investment in South Carolina public utilities. So it's a pretty complex role that they play. And I would distinguish their role from the consumer advocate's role in that, from what I've seen, the consumer advocate is generally focused on the average ratepayer. And based on the stipulation, it seems, or not that it seems, based on the stipulation, Piedmont is in agreement with the Energy Users Committee, right?
That's my understanding.
Okay. And Piedmont is also in agreement with the Office of Regulatory Staff.
That's also my understanding.
All right. And so ROE and capital structure, there seems not to be agreement with the consumer advocate. Is that fair?
That's also my understanding, yes.
Okay. And based on the experience I have here, it sort of makes sense considering that the consumer advocate is representing Joe ratepayer, if you will, because in my experience here, usually there's not much understanding as to how a utility company gets a rate increase. There generally seems to be a lot of confusion regarding that. So I have no reason to believe, and there's no evidence to support, that Piedmont is not an outstanding company that manages its resources well and provides outstanding service to the customer. There's no reason to believe that. I think where we are here is trying to understand, and I'm just going to state this my way, how much money should Piedmont be allowed to earn? Is that a fair description of ROE and cap structure?
It is. It's the crux of the matter.
It's the crux of the
What's
matter.
the allowed return,
Right.
which is measured in terms of ROE and capital structure. So
Right.
I believe you're correct in your characterization.
And that's stated very eloquently, and I appreciate that. But for those watching out in, I call it TV land, that have the opportunity to listen to and watch this proceeding now, live stream, and some point in the future if they decide it, because we post these on our website, I think it'll be easier to understand that for the average listener that we're here trying to decide how much money should Piedmont be allowed to earn. And it's an interesting question, in my opinion, when you put it that way. How much money should you be allowed to earn? Should Piedmont, not you, but Piedmont. I see on your CV that you worked for the Maine Office of Energy Resources back in 1981 through 1982?
I did.
Okay. What did you do in that capacity?
It was my first job out of graduate school. I was the state's energy economist before we even knew what that meant. So my job was to work with a group of people who were coming together, appointed by the governor, and figure out how to do energy planning in an environment with rising energy prices, high inflation, and figure out what was in the best interest of the citizens of the state of Maine and what could state government do to empower consumers to have some control over their energy future. That looked very scary at that point in time. You know, it was a part of the country then, even now, that was heavily reliant on imported oil, and gasoline prices were increasing at an unprecedented rate. So my job is twofold. One is to create an energy plan for the state, and did so, and had that approved by the governor and legislature, working with a team of people. And my second job was to represent the Energy Office before the Public Utilities Commission of the state of Maine on matters that came up primarily then pertaining to what were reasonable rates for electric generation. This is when the Purple Law was just being implemented, and in Maine there was a lot of generation that was owned by forest companies and paper mills and things of that nature, and to help them determine what was a reasonable rate to pay those companies for providing electricity into the grid. So I testified before the Public Utilities Commission at that point in time, and I just represented the Energy Office on various issues pertaining to nuclear power and solar and what was possible, and biomass, what was possible. So that was my general role there.
All right, thank you for that. And here you are before the Public Service Commission of South Carolina, testifying on behalf of Piedmont. And I think your time at the Energy Office in Maine will be very helpful for us here for this line of questioning. At some point when we finish this hearing, the commission will be responsible for issuing an order where we decide this matter. And I'm an advocate for our orders to be as clear, direct, concise, and easy to understand, so that a ninth grader could understand why we made the decision that we made in each of our cases. If I could rule the world, that's how all our orders would read. And so I want to elicit your help in that through this line of questioning, starting with this question. What would happen, in theory, obviously, based on your experience, what would happen if the commission decided that the DCA's witness Rothschild, if his recommended ROE and cap structure was appropriate? What would be the outcome to ratepayers?
Well, I think there'd probably be short-term effects and ripple effects and longer-term effects. In terms of ratepayers, the immediate effect would be that it would lower the rate to customers over as compared to the proposed ROE in the settlement, because it produces a lower cost of capital. So the revenue requirements for the company would go down, which would translate into a lower rate. Then there'd be secondary effects. I think the next effect that I would expect would be the credit rating agencies that rate Piedmont's credit would note the decision. They would note that it was unprecedented in terms of U.S. allowed ROEs and capital structure, and I would expect to see some pretty negative ratings responses from them. Even I would expect downgrades would be more likely than not from Moody's and S&P and potentially Fitch's as well. And as a result of that, the cost of debt for the company would increase. So I think there'd be an immediate reduction in the rate as it would flow through. And then after that, I think there'd be some offsetting increases in rates as the cost of debt would increase, and that gets flowed through to rates. And I think there's a third effect that's more difficult to judge, and that is that if you think about Piedmont, it's part of a holding company, Duke Energy. And the way holding companies work is they allocate capital according to where it's best needed, and they also allocate capital according to where it can earn commensurate returns for the risks associated with it. And I would imagine that at the holding company level, they would have some concerns about the quality of regulation in South Carolina if that were the case, because it would just be such a departure for the regulatory environment historically in South Carolina in terms of how it's approached these issues. Harder to determine how that would impact the company and customers in the long run, though.
Okay, thank you for that.
As a case in point, just to drive some real-world evidence home here, there were decisions made in New York State over the past year where the company lowered the equity ratios of the three gas utilities from 50 to 48%. And then even though it increased the allowed ROEs in New York State, which are some of the lower in the country, but they increased them from 8.8 to 9%. And Central Hudson Electric and Gas, NYSEG, and RG&E were all immediately downgraded by Moody's as a result of that. So it happened very quickly and across the board for the state's three gas and electric companies, just as a result of that incremental change. The change that Mr. Rothschild is recommending is much more severe than anything that happened in New York.
Understood. Thank you for sharing all of that. And so just to keep this at the top of mind, because you're in agreement, or the company is in agreement with the Office of Regulatory Staff and with the South Carolina Energy Users Committee, I am asking you a line of questioning that is exploring the differences between the consumer advocates, experts, and your analysis here, what you've offered to us. So I ask this next question with all due respect. So what if the company is downgraded? What does that mean to Joe ratepayer, the average ratepayer, the residential ratepayer?
It means that the cost of debt, that the next time the company comes in for a rate hearing, that you would expect that the cost of debt that the company is paying would go up as a result of that credit downgrade. So there'd be some offsetting increase to customers as a result of that credit downgrade.
All right.
And in good times, the difference between a good credit rating and a nominal credit rating or a bad credit rating can be compressed. In bad times, those differences can be very significant.
All right. Thank you for that. I appreciate that. I want to probe a little bit deeper. Do you have a real-world example of that happening?
The credit downgrade?
A credit downgrading that led to increased cost of capital that ultimately increased rates.
I didn't look at the cost of capital for these three companies. This just happened all within, this is July through September of 2021. And it's something that'll happen over time. So as the company goes to capital markets to raise new capital, it's inevitable that they would pay more for, they're now rated Baa1 instead of A3 where they were before. And it's inevitable that they will pay more for debt capital as a result of that. But I have not, this just happened and I haven't examined the impacts.
Would you agree with me that the commission stands in place of the market in this regulatory, in South Carolina's regulatory scheme?
Yes, I do.
Okay. So, considering all the uncertainty, considering all the changes that are happening in our economy, what justification other than economic theory can the commission give for not seeking to provide the lowest rates possible to ratepayers while also giving the company a fair rate of return?
I want to make sure I understand your question, Commissioner. I think that, as I understand it, you're asking, maybe I could paraphrase, why not just set the rates as low as possible? Isn't that in the best interest of consumers? Is that another way to think about it?
That's fine. That's fair. That's good enough. Let's go down that road.
Okay. And the reason for that is that there's a legal standard, and the legal standard exists for a reason, and that is that in order to provide a stable industry, the electric or gas industry, or the water industry for that matter, there's a standard by which regulators are guided, so that otherwise the temptation for regulators might be to set rates of return too low, and there might be a temptation for companies to request rates of return that are too high. And so therefore the Supreme Court decided on this matter back in the 20s and the 40s in these Hope and Bluefield standards that we've discussed. And they guide the commission. And the ultimate guidance is that the commission needs to determine a fair return. And I would hope that ratepayers understand the concept of fairness is a reasonable one. Fair is what you could get elsewhere if you were to invest the same capital in some other enterprise that looked a lot like this one or the same risk. And that fair return has to meet three tests. And it's the test, an important test is that it's comparable to returns that the company or those investors could earn elsewhere. And Mr. Rothschild's recommendation would not pass that test of comparability. As I mentioned, the national average allowed ROEs for gas utilities in the U.S. is 9.53%. So we know that 7.86 is not equivalent to 9.53. So it fails the fairness standard on that basis. It's not comparable. And then the other issues, the other two tenets of the Hope and Bluefield standards is that it needs to allow the utility to attract capital on reasonable terms and maintain the financial integrity of the company. And if the awarded return is insufficient for the company to maintain its credit ratings, then it jeopardizes its ability to attract new capital on reasonable terms. And all three of those standards have to be met. It's not sufficient to say, and Mr. Rothschild even suggests this in his testimony, that look at ComEd. ComEd has the lowest allowed equity return in the country as a result of a formula that's been in place for 10 years that'll expire this year. And his point is, look, they have an ROE a lot like that I'm recommending, and they're still raising capital. So why isn't that sufficient, seems to be the logic. Well, that ROE does not pass the fairness test. That ROE law, that formula will expire this year, and the Illinois Commission is replacing that formula with national average ROEs for electric utilities. And that, in my mind, is much more fair than a formula that was tied to government bond yields that might have looked good 10 years ago when it was first set, but over the course of the past 10 years, it started producing returns that were not reasonable and fair. And that's why that commission is now changing its approach to ROEs. And investors they take a long-term view with utilities. They may not overreact to something that's negative in the short term if they think it's going to be fixed in the long term. But it ultimately comes back to what would the Supreme Court tell you as a regulatory body is a fair return, and those are the standards that I would suggest needs to be met by the evidence that's on record before you. What's a fair return? Not the lowest possible, but a fair return.
Understood. Thank you for sharing that. And so just to make it clear, is your testimony that 7.86 as a rate of return return on equity is unfair and would not pass the Hope and Bluefield standards.
That's correct.
Okay. Because, just taking the argument all the way to the end, because it would lead to Piedmont's credit rating decreasing, being downgraded, which would lead to increase, if not unreasonable, cost of debt, which would, what's the next step?
Which would be passed through to customers.
Which would be passed through the customers at some point in the future.
There would be a short-term decrease in revenue requirement followed by a reversal when the new cost of debt gets flowed through to customers.
Right. I want to flesh out the unfairness part a little bit to Piedmont. So it's unfair because the national average is higher than 7.6, and it's unfair because 7.86, and it's unfair because if we approved a 7.86 return on equity, it would cause the company to pay increased costs for debt. Is that why it's unfair?
Yes, in the first case, it doesn't pass the comparability test compared to other gas utilities in the country. It's also unfair because it didn't, that's looking at what was in place over the last 2 years. My analysis shows that the cost of equity should be higher than those national averages. I would suggest that that's a minimal level given where we are right now in the economic cycle. The cost of capital is going up. So it's unfair because it doesn't match the investor return that's suggested by the financial analysis I provided as well with the 4 models. And in terms of the cost of debt, I'm not a credit rating expert, but I can observe what's happened elsewhere to companies that have had far less negative decisions than would be suggested by Mr. Rothschild. And they experienced a credit downgrade. So I would expect that there would be an equivalent or more severe result if his recommendation were adopted, because there's been no allowed return in the U.S. set at the level that he's recommending in the last 40 years. And so I believe it would be viewed as being an extreme result in both the investment community and in the regulatory and in the from credit rating analysts.
Okay, thank you for sharing that, sir. What is the lowest end of the range you offered to the commission as a fair return on equity?
I calculated a range in my results, which I'll refer to here. In February, when I submitted my my direct testimony of 9.47 to 10.84%. When I updated that analysis using June data, it was 9.74 to 10.17%. So the range increased because the models moved around a bit. The DCF stayed about the same. The CAPM went down, but the risk premium model came up largely as a result of interest rates coming up over the course of that 4-month period.
Okay. And the stipulated ROE, the stipulation that you have with ORS and the Energy Users Committee, is it within your updated range?
If I look at the range of results across the companies and the proxy group, it is within the range. The range I cited to you is across the 4 models. If I look at the range that's within each of the companies in the models, that's slightly broader. And I think I cited that in my opening remarks. That's 9.04 to 11.12%.
Okay.
So it's within that range. Okay. And in part on that basis, I concluded that it was still a fair and reasonable return, although it was lower than that I had deduced and recommended.
So is it your testimony that 9.04 return on equity is a fair and reasonable rate of return?
No, I believe that's too low. I'll revert back to the national averages and those that are awarded to the other companies that are in the proxy group. And those are 9.53%, which is the national average ROE. And for those in the proxy group, their average awarded ROE is 9.63%. And all those have been previously settled when interest rates were lower. So even though I calculated that range using my models, I think it's too low compared to what a fair and reasonable return is as we sit here today.
Understood. So this is where I begin to get confused. So I'm going to need you to help me here. It seems as if the stipulation is lower than the average, the national average.
It is.
Okay. It seems as if the stipulation is lower than your updated June range of 9.7 to whatever the top of the range was.
It is at the model level. It's not at the company level, but I realize that's a nuance, but it's within the broader range when I calculate it across the models for each of the companies that are in the 6-company proxy group.
Right. But 9.04 is also in the broader model, is it not?
Yes, it is.
Okay. So why is 9.04 too low, but 9.49 appropriate or fair and reasonable?
Well, it may sound to you like I'm putting a lot of weight on this, and I am, because at the end of the day, I recognize how much uncertainty there is around estimating these models, and how frustrating it is to sit in your seat to try to determine which of these inputs is more reasonable, which of the models is better. So I think the national average is a good acid test for what's reasonable and fair. And I think to go below the national average right now, and I understand this is 4 basis points below that national average, but I also respect the fact that in a settlement agreement, there are gives and takes between the parties, and that there can be some flexibility around those gives and takes when it comes to the earned return, if there's some benefit that's provided elsewhere that's deemed as being offsetting. And as long as it's approximating that national average of 9.53%, I would not argue that my analysis is so accurate that I can say that 4 basis points is just not right. I think it's within the range of what's appropriate and supported by that national average. So on that basis, when I was asked my opinion on it by the attorneys for the company, I considered it, I considered my analysis, and I said, I believe that that's still within a reasonable range.
All right. So I'm sorry, but I have to do this. So 9.49 is within a reasonable range, or it's reasonable. It's fair and reasonable, right?
Yes.
What about 9.48?
I couldn't quibble over 1 basis point.
What about 9.47?
The farther you get away from that national average, the more concerned I become that you're no longer meeting the standard of reasonable and fair. But I also take stock in the fact that the parties sat down at a table together and they agreed what they thought was fair. So I'm deferring to their discussions and their negotiations around what they thought was fair. And that's important.
I agree with that. But all the parties did not agree. We still have to deal. The only reason that we're having this line of questioning and having this discussion is because there's one party that did not agree. That's the DCA. And so we can't discount that party. We have to treat all parties fairly. And I am struggling here, and maybe this will be addressed in recross. I'm struggling here. While I understand the art of negotiation and the benefit of allowing parties to work out their matters, I get that. I'm struggling on the academic or the theoretical side of ROE analysis, where we can say, or you can say as an expert, that 9.49 is fair and reasonable, even though it's lower than the national average. But now 9.04, which is in the broad range that you recommended, is no longer fair and reasonable. I'm struggling with that. I would just really have to accept it because you say it.
Well,
Can you help me there?
Let me see if I can. You know, 9.04 would be 45 basis points below the stipulated ROE, and that's a pretty big difference. You know, that's more than 1 basis point. And it's the range coming out of my models, but I look at the central tendency of the models as a basis of my recommendation, which formed the 9.09. I'm humble enough using the analytical tools that we have before us to say that I can't say with precision the number is 9.9. There is a range around that 9.9 that could still be deemed as reasonable. The next thing I look at are these national averages because it goes back to the comparability standard. And if other utilities in the country that look like Piedmont are allowed 9.53%, why would a comparable return be anything less than that? And if you were to ask me, is 9.49% close enough, I would say that's pretty close. That's 4 basis points away. That's 45 basis points is a much bigger difference. I can't tell you there's a bright line there around what's fair and reasonable and what's not, but I would stop at the national average or thereabouts under these circumstances.
No further questions, sir. Thank you.
You're welcome, Commissioner.
Thank you, Commissioner Williams. Commissioners, other questions? Commissioner Thomas?
Thank you. Good afternoon, Mr. Coyne.
Good afternoon.
I think it is officially afternoon at this point.
Yeah, I see that.
So I'm looking at the settled, agreed upon ROE at 9.49. And just looking at the initial recommendations, and if you just take a straight average of the three parties that agree, being ORS, Piedmont, and the energy users, straight average of that is 9.5. So you're looking at an average of 9.5 compared to a settled of 9.49. Pretty much the same number. I think most of us would agree. So just looking at it that way, and I'm just kind of kicking things around. It just looks like that Consumer Affairs was not part of the agreement and that they were just ignored. And that gives me a little bit of concern. I know you all can't talk about how did you get to that number, or at least you usually don't do that. But if you can give me a little bit of help that would indicate that maybe Consumer Affairs, the customers, that's what they're charged with representing, at least got a look-see.
Well, perhaps I'm not sure if I understand your question, Commissioner. Could you state that for me so I can be responsive?
It just looks to me like the straight average of the three that agreed is basically the number that was settled upon, and the one that didn't figure into it. If you figure Consumer Affairs, make it a four-way average, it comes to 9.09%. So I'm just trying to get a feel for, okay, so maybe they're not part of the agreement, but maybe they had some input that was meaningful, but since they do represent the customers, can you help me along those lines?
I really cannot, because I was not party to those discussions, nor the basis for how they arrived at the 9.49. So I'm afraid I really can't provide any color to you around that. I could surmise, which maybe is dangerous, but if Consumer Affairs' position was that 7.86% is a right and fair reasonable return, I could see why they wouldn't be able to settle around that position, because it's just so far off the mark. So that would, if we abstract ourselves from this discussion, think about any time that we had to negotiate around the purchase of something. For example, you had to agree on a reasonable price. If the parties start off coming from the same perspective, then they're much more apt to settle on something they consider to be fair and reasonable than if one party's position is extreme. And in my view, if Consumer Affairs' position is based on Mr. Rothschild's analysis and recommendation, it's an extreme position, and it doesn't lend itself to compromise.
Okay. Let's talk about equity here for a minute. So the settled equity was 53.5%. And again, just looking at a three-way average of the settling parties, that comes to 52.56%. So that one is significantly higher settled than what the three-way average was of the parties that did agree, for whatever that's worth. And again, if you throw Consumer Affairs in there in the mix as well, you come to 50.57 equity. And so here's where my concern is with this. And you mentioned Duke, the parent company, and the allocation of capital to Piedmont. And my understanding is that Duke, the parent company, is 42% equity, which makes me wonder, how do they ever borrow money? But I'm not asking that question. So let's talk a little bit about the whole Duke company and that 42%. And let's think about the other entities that make up the Duke companies. I mean, they have multiple utilities in multiple states. And in my opinion, we have some things in South Carolina that apply specifically to Piedmont that are helpful to their credit ratings. One of them would be the Rate Stabilization Act. You might not think that's the best of all possible, but it's certainly a stabilization factor that applies to Piedmont in South Carolina. The same thing with the weather normalization adjustment. That's another one that is a less risk scenario for Piedmont. Would you agree that those contribute to a lower risk?
Let me see if I understand your question, Commissioner. Are you asking the question of whether or not Duke Energy Corporation's regulated utilities contribute to a lower risk profile for the corporate entity?
Well, that's part of it, but the other part is Piedmont. Does Piedmont contribute to a lower risk profile? And in part due to the Rate Stabilization Act and the weather normalization adjustment.
Compared to other Duke affiliates?
Yes.
Well, each of the Duke regulated entities has its own risk profile. The electrics are different than the gas, and they also vary by state. So I have not compared how Piedmont's risk profile compares against those other companies, because that would have been deemed to be circular. We looked for risk profiles outside of Duke to look for other entities for establishing the fair return. So I didn't do that analysis around how their regulatory provisions compared to the other Duke affiliates.
Okay, but you did mention that Duke allocates capital to its subsidiaries, if you want to call it that. and that Piedmont runs the risk if we get a little bit too far out of line, then Piedmont runs the risk of not getting the capital allocations from the parent company. Did you not?
Yeah, to clarify that, the way holding companies work, in my experience, is that there's always more capital requested by its operating subsidiaries than the parent company wants or has to provide. So there's always a competition for capital within any holding company structure. And you're in a better position to compete for that capital if you're earning a commensurate return with what the company can earn elsewhere in its other regulated utilities in this case. And if you're providing a return that's viewed to be substandard, then the holding company is apt to be more stingy when it comes to allocating capital to that entity. And in the most extreme cases, I've seen holding companies that have just decided they're going to exit a jurisdiction if they felt as though they didn't have the opportunity to earn a commensurate return there.
Okay. So I guess one of my concerns here is, again, that, well, first off, it seems like everybody asks for more than they can get, whether it's companies asking for capital or companies asking for rate of return or capital structure. Everybody asks for more than they probably deserve. And we're here to try to piece all of that together. So that's where I'm coming from. And my concern is that this settlement puts Piedmont contributing a bigger share to the puzzle of the Duke companies than it should. And if that is the case, then the Piedmont customers are the ones that pay for that. Is that correct?
Well, I think there is in your question, there's both a statement and a question. Let me see if I can address it. That one is, there's a suggestion that Piedmont is returning something more to the parent than its other affiliates. And at one point in time, I did look at the allowed returns for the other Duke Energy affiliates, and I don't believe that's the case, that this would represent a higher return than the company is earning elsewhere. So I don't think that that's correct. But the second party, and then the question part of your statement was, well, perhaps you could rephrase it.
Just that if that is the case, if Piedmont is a higher capital structure, higher equity, then the Piedmont customers would be paying higher costs and more than their fair share relative to some of the other entities at the Duke companies.
No, I fully understand the question. Two answers. One is, I don't think that that's the case, that it is a higher return on equity, for sure not a higher return on equity. I don't recall exactly what the allowed capital structures are for each of those utilities, though. But the second part of your question, would they be overpaying or would they be paying more than a fair return? And the answer to that is no, because the analysis that I presented to you shows what a fair return is. It's not too high, it's not too low. It is a fair return based on the company's risk profile. What the financial analysis suggests an investor return is for a company like Piedmont, and it's also based on the actual capital structure for the company that's competitive with how other natural gas utilities are financed. So Duke has other affiliates that have different risk profiles. It's up to each of those commissions to decide what a fair return is for those affiliates. And under the standalone principle, the job of this commission is just to determine what the fair return is for Piedmont Natural Gas. And if you and other commissions do the same thing, then ultimately the fair returns are ones that roll up to the parent company as they should.
Okay, thank you. That's all I have at this time.
You're welcome, Commissioner.
Madam Chair?
Commissioner Irvin?
Yes, thank you. May I ask the witness some questions, please? Mr. Cohen, how are you, sir?
I'm well, thank you.
Good. I want to try to put this in some perspective for those who might not be understanding the debate that we're having, just to put it in ratepayer terms that they can understand. We accept the stipulated settlement agreement by all the parties except for one. That will result in about a $10 a year increase on the average ratepayers, residential ratepayers bill. Is that true?
I don't know that figure, Commissioner.
Well, if you'll assume for me that that's correct, I think that comes out to maybe 72 cents a month increase if the settlement agreement is approved. Is that by in terms of rate cases, is that a large increase or not?
In what I'm seeing over the last year in rate cases, the rate case requests are higher than I've seen in the last 20 years for a couple of reasons. One is that costs are increasing. Some of the inflationary pressures we see in the broader economy are filtering through to utilities. So they're paying more for labor and O&M expenditures and things of that nature. And there's also a lot of capital that's being spent both for electric and gas utilities to maintain their systems, provide reliable networks and things of that nature. So they're putting cost pressures on rates. And of course, in natural gas, we're also seeing the pressures of commodity costs that are running in the $7 and $8 an MCF for natural gas. And we all can think back to the good times when they were under $2. So all those things are putting rate pressures. So those to me do not sound like unusually large rate increases in the current environment.
In fact, compared to the other cases that come before us, it's a minuscule increase, really, considering what we look at, for example, when we've got electric-owned utilities coming in and asking for us to double their fuel allotments because the natural gas and coal have doubled in the past 12 months, and those costs have to be passed through to the ratepayers. So those are substantial increases. And then there are just the rate cases alone that deal with the rate base are much more substantial too. I'm just trying to put in some perspective for those that are worried about it. It seems to me to be, as you've said, a fairly reasonable request given all the things that we have to consider. Would you agree with that?
I haven't, to be fair, I haven't judged the overall reasonableness of the company's rate request as I've focused on the cost of capital, but the numbers that you cite are much more moderate than those I see in other proceedings where I'm involved, where I see rate requests for base rates that are 20% or higher. And these are for companies that haven't been out for very long periods of time. They've been out in some cases for 2 or 3 years. But the kinds of cost pressures that we're seeing now, we just haven't seen in recent history. And it's reflective of where we are in the economy and where we are with these industries.
The other point that I wanted to give some perspective on in terms of this proceeding is, of course, we've got 17 witnesses. You're number one. If we go through a process of full cross-examination and all 17, we could take up 2 or 3 weeks of time. Of course, that adds to the cost of rates too, because your fees have to be paid, the attorney's fees have to be paid, and if there's an appeal, that would have to be paid for by the ratepayers ultimately. I guess kind of thinking that common sense says you kind of pick and choose your battles. If three of the four parties have come to full agreement on all issues, does that give you some comfort in knowing that the great majority of the issues have been resolved except for these two? And would you comment on that from your perspective?
I'd be glad to, even though I wasn't involved in the settlement discussions. I personally like settlements because I find that they usually reflect important trade-offs, and commissioners aren't always in the best position to understand what the gives and takes of the parties involved are. They know their own preferences and where they're willing to give and take. So I think anytime parties can come to agreement on something that's so important as the allowed return, especially when that allowed return is supported by the evidence that's on the record, that's a good thing. And I feel better about that oftentimes than having a commission have to sort through the evidence and make those decisions, because I think they're hard ones. And I think the parties are in the best position to understand how those trade-offs can be made, especially when they represent the interests of both consumers and the company.
Well, and they represent the interests of not just the residential ratepayers, but the commercial and industrial ratepayers. ORS, of course, is defending the public interest. They've signed on. And so you mentioned another thing that I wanted to point out, and that is the potential rate of return is not a guaranteed rate of return, is it?
It's not.
And in fact, some of the rates of return that I've sat on the last 4 years, we actually never saw the utilities reach the allowable rate of return. They fell short in the majority of cases. So it's not like we're guaranteeing that Piedmont Natural Gas is going to get a certain return. They have to still go out there and earn it, right?
Yes, they do.
And what that means, they have to earn it despite the fact that their employees are going to be, expecting a rate they're expecting a increase in wages and benefits, because right now we're under inflationary pressures and everybody needs a little more to pay their bills. True?
It's very true. Yeah, I think we're going to, we're in a cycle that we haven't been in for 2 decades of increasing costs across the board. And utilities are consumers of services just like the rest of us are. And ultimately, it's up to the utility to manage its costs efficiently and economically, but ultimately increasing costs have to be flowed through to rates for the customers.
And that includes the rising interest rates that they have Piedmont has no control over that. They have to pay the going rate, correct?
Yes, they do.
And so that has to be considered as well. And so if we accept Mr. Rothschild's turn on equity, aren't we kind of gambling that Piedmont could perform in a reasonable, efficient, and effective way with that kind of being handcuffed, with that kind of cap on their potential earnings? I mean, isn't that a risk?
I think in the long term it is, because the company needs to be able to raise capital to maintain safe and reliable services. And I also think it would send a signal about the South Carolina regulatory environment that would be very negative, not just for gas utilities, but for electric utilities and water utilities. Investors and companies like the Regulatory Research Associates cover regulatory environments, and that would be viewed as being an outlying result and indicative of a shift in the regulatory climate in the state of South Carolina.
So it wouldn't just affect Piedmont, it would affect every investor-owned utility that's subject to our regulatory authority. Is that what you're saying?
I believe it would. specifically from a credit rating perspective, because credit rating agencies would believe that it would portend for other decisions.
And that's all the more reason why we should stay within kind of the middle ground of these ranges, because if we vary sharply one way or the other, that sets off alarm bells with the ratings agencies, right?
It does, and with the investment community.
And what that does, it comes back to bite our ratepayers in the wallet, because we did not accept reasonable terms that the parties agreed upon except for one. We run the risk of hurting the consuming public when we take that kind of risk. Would you agree with that?
I would.
And so for all those reasons, do you think it's reasonable for the commission to accept the stipulated settlement agreement as presented?
I do.
Do you think it's in the public interest?
I do.
Do you think it's in the ratepayer interest?
I do.
Do you think it's in the company's best interest?
I do.
Thank you. No further questions.
Thank you, Commissioner Irvin. It's about 12:42. We're going to break for lunch. I think there may be one or two more questions from commissioners, and then there may be redirect. We are probably going to go till after 5 today, so just be prepared. We will take an afternoon break in the middle of the afternoon, though. With that, comment, Mr. Hessling?
No.
Okay.
No comment.
Thank you. We will recess until 2 o'clock. Thank you.